Is your holiday wish to buy $1 million home in New Jersey for 2025? Then look no further, because in this video, I'm going to help you make that wish into a goal by letting you know exactly what you need in order to afford one. Hi neighbors, welcome to my YouTube channel. My name is Gabby and I'm a New Jersey mom and realtor who makes videos about everything real estate, New Jersey living, travels, and family life. If you enjoyed that type of content, then you will enjoy my videos. So don't forget to hit the subscribe button, click the thumbs up, and ring the notification bell. Today, we are diving into finding out how much it actually takes to afford $1 million home. Buying in this price range is more than just having enough down payment. It requires a very strong financial background. So in this video, I'll break down the income, mortgage, and other factors that come into play. And just a quick disclaimer, I'm not a mortgage loan officer, nor am I a mortgage broker. So once you watch this video all the way through and you are ready to get a more personalized pre-approval based on your personal financial information, then feel free to comment your email down below, or you can also email me at gabbym@kw.com, and I will be more than happy to introduce you to one of my preferred lenders so that they can give you a personalized and more tailored to you information that you need in order to make your dream of buying $1 million home in New Jersey a reality. And with that, let's get into it. So now let's start with income requirements. A good rule to follow is a 28-36 rule. The 28-36 rule says that 28% of your gross monthly income should be allocated towards your housing expenses. And then 36% of it should be allocated towards your other debts, such as your credit card debt, student loans, or car loans. In this video, I'm using the 28-36 rule because it informs you about what is a safe amount of debt for a person or a household to carry based on their income. Following this rule can ensure that you can comfortably afford your mortgage payment and stay in your budget. However, while income is important, what's more important is the ratio between your debt and your income, or what's also called debt to income ratios. This is what lenders will use in order to qualify you for a mortgage. And I will talk more about that in a later section. Now, let's talk about numbers. Let's assume you're looking at a $1 million home in Basking Ridge, New Jersey, and you will be putting a 20% down, which is about $200,000. This would leave you with an $800,000 mortgage loan amount. And for our example, even though interest rates have been fluctuating like crazy in the past year or so, I'm going to be using 7% as our interest rate. So here's how the payment would break down. Principal and interest on an $800,000 loan at 7% over 30 years is about $5,320 a month. Now, for property taxes, we're going to use about 2% of the home's value per year in New Jersey, and that gives us a rough estimate of about $1,667 a month. And your home insurance will be, we're gonna use about $150 a month for this scenario. Using this information, the total estimated monthly cost is about $7,137. So this includes the principal and interest, property taxes, and insurance. And we're using those four because that's what lenders use in order to pre-approve you when you are actually obtaining a mortgage. They take all those four things into consideration, and that is the monthly mortgage amount that they will approve you for. So based on this monthly payment, how much do you actually need to make per year in order to afford this? According to the 28% rule that we were just talking about earlier, your mortgage payment should not exceed 28%, as I mentioned. So if we take that $7,137 and divide it by 0.28, which is the 28%, we will get about $25,490 a month, monthly in gross income. If you multiply that by 12, that's an annual income requirement of roughly about $305,380. Based on the 28% rule, that is how much you need to make in order to comfortably afford $1 million home in New Jersey. So if you are a couple, maybe $150 each of gross annual income would be perfect for the both of you in order to afford this property. But wait, that's not the full picture. There are other factors that will come into play that can impact your affordability, which include the debt to income ratio, which is what I was talking about earlier. When lenders look at your finances, they will look at your debt-to-income ratio. A debt-to-income ratio is a personal finance metric that compares your monthly debt payments to your gross monthly income. And the formula for the debt-to-income ratio, or DTI, is total monthly debt divided by your total gross monthly income, and then you multiply that by 100. So lenders use debt-to-income ratios to determine your eligibility for loans and credit cards, and in this case, we're calculating mortgage payments. A higher debt-to-income ratio typically indicates to lenders that you have more debt relative to your income, which may signal to lenders you may have trouble covering your debt and other expenses. So what you want is to have a lower DTI, because that will indicate that you are a better and more reliable borrower. As a general guideline, again, while lenders vary, about 45% is the maximum DTI that a borrower can have in order to get qualified for a mortgage. However, ideally, lenders really prefer their clients to have a debt-to-income ratio lower than 36%, with no more than 28 to 35% going into your mortgage expenses. So if you have other debts like car loans, credit cards, student loans, your lenders will calculate your debt-to-income ratio using those factors. They ideally want your debts, including your mortgage payments and all your other expenses, to be 36% or below. But like I said, maximum, typically you can go as high as 45%. So if, let's say, you're paying $1,000 a month on other debts, that will reduce how much you can afford to spend on a mortgage. And because of this, it might even increase your income requirement. Now, if you are interested in how much income you need based on that maximum 45% debt to income ratio, assuming that you don't have any other debt, using the same example below, then we can divide the $7,137 per month by 0.5% instead of that 0.28 that we did earlier today. And this will amount to about $15,860 in monthly gross income. Multiply that by 12, and that's roughly about a minimum of $190,320 of income per year, assuming that you do not have any debt. So it's possible that if you don't have any debts and you are using that maximum debt to income ratio that most lenders typically allows you to have in order to obtain a mortgage, then you could technically earn about $190,000 as a single person or combined with a significant other to buy this $1 million home. But just because you are approved for it doesn't mean that you should, because you want to still stay in budget, and also remember that a bigger house typically means more maintenance as well. And in addition to your debt to income ratios, lenders will also look into your credit score. Your credit score matters a lot. A higher credit score means that you can get a lower interest rate. You want to have a higher credit score because a higher credit score can get you a lower interest rate. Lower interest rates can make a huge difference in the monthly payment, which then can possibly reduce the amount of income you also need in order to be approved for a mortgage. Generally speaking, lenders like to see at least 640 or above. However, the best interest rates are typically granted to people with over 720 credit scores. And lastly, the down payment is also a huge factor. And of course, if you put down 20% or more, that would be better, because that would mean that you would have a lower loan amount, which will mean a lower monthly mortgage. However, it doesn't mean that you won't qualify for a mortgage if you do not have 20% down. Some mortgage programs will allow you to put down as low as 3 to 5%. If you do put down 20% or less, most of the time they will require you to pay an additional monthly payment called private mortgage insurance, or PMI. So a lot of people really have to have that 20% down so that they don't have to have this extra additional monthly payment. And on top of your monthly mortgage, don't forget that you also have other costs that you have to account for, including utilities, maintenance, and closing costs. So closing costs is in addition to your down payment that you need to have to buy a home. And usually closing costs are typically about 2 to 5% of the purchase price. So for a $1 million home, you're looking at about $20,000 to $50,000 upfront. And then there's also maintenance and utilities, right? Because it's not all about acquiring this $1 million home, it's about maintaining it and making sure that you don't lose it. And with that, you need to prepare to have emergency funds for maintenance and also add additional payments that will require you to pay for in order to have lights on in the house for utilities. And some towns require you to pay for garbage, some towns may not. You may have a septic system, or you have to possibly pay for public sewage. Some towns it's free, you don't have to pay for that. So it really depends on that property and the town. But regardless, there's going to be extra payments that you still need to make in order to make sure that you have water, lights, gas, and all that stuff going for you so you can actually live in your $1 million home. And lastly, New Jersey has a 1% mansion tax. It is a state-imposed tax that typically buyers have to pay for. And it is a tax only imposed on real estate worth $1 million or more. So if you're buying a home that's over $1 million, this is something that you have to take account for. And again, this is usually paid by the buyers. This tax is an additional fee on top of the 1% realty tax fee paid by the sellers and other costs of selling a home. To sum it up, to comfortably afford a $1 million home in New Jersey, you should ideally put down at least 20% or $200,000. And you have to take into consideration that you also have to save for closing costs, and you'll likely need a gross and annual of around $305,000 or more. Of course, this can vary based on your financial background, your debt, credit scores, and down payment and interest rates. But generally speaking, this is what you need in order to afford one. So I hope this video helps you out. If you're interested in seeing how much these numbers might look using different scenarios, such as a lower down payment or adding additional debt, drop a comment below. I'll be more than happy to estimate based on different financial factors, such as a different down payment, different interest rate. So that's it. Thank you so much for watching. I hope you enjoyed this video and you learned a lot. And now that you watched this video, you are one step closer to getting that $1 million home. And if you are curious to know what is the minimum amount of down payment and income you need to make in order to afford a New Jersey, then tune in to my next video next week. See you guys soon. And I can't wait to help you reach your dream of living in a $1 million home in New Jersey. Talk to you guys soon. Bye.